So I'm not sure how many of you are aware of this, but Vanguard is the second largest investment management company in the entire world, only behind BlackRock, with an estimated assets under management of over $7 trillion. It is just such a massive, massive size. And they really gained popularity for their various funds and ETFs that typically have low expense ratios and become popular among more kind of passive minded investors that just want to own a large basket of various different stocks within a certain fund or ETF. And as such, Vanguard has really grown into one of the largest issuers of bond funds. They are the second largest issuer of ETFs, and they are the number one largest for mutual funds. So guys, when we talk about these massive sizes here, it's really these investment management companies like Vanguard and BlackRock that have the most influence on the stock market in terms of what they're buying or selling. They're what really moves the market. And so in today's video, we're going to take a closer look at the 5 largest stock purchases that Vanguard most recently made in the last reported quarter. And I'm going to give my opinion on each one of them, and I'll even rank them from best to worst like we always do, just for fun, make it a little more interesting. So I hope you enjoyed the video. I can't wait to share these with you. And if you are enjoying the channel, please consider subscribing. Really helps keep my channel alive. YouTube is actually putting a ton of emphasis right now on subscriptions, people subscribing for the algorithm. So if you don't mind subscribing, it really just helps the channel a lot, helps keep it alive, and it means the world to me. So thank you for all your support. It's a free thing you can do, and it really helps me out a lot. So thank you for that. But with all that said, let's not waste any more time. Let's go ahead and jump straight into this list. All right, so we'll be counting up here from smallest to largest position in the portfolio. And coming in at purchase number 1, that's going to be a stock that I've actually never talked about before on the channel, and that is Xylem, ticker symbol XYL, which Vanguard has been consistently investing in for some time, and now decided to increase their position again by a whopping 31%, adding over 6 million more shares, bringing their total stake in the company up to over $3 billion. And yet it's not even worth 0.1% of their total portfolio because of their massive size. I mean, how crazy is that? Anyway, if you've never heard of Xylem before, they're a water management company, and I gotta say, I love their business for that, because we all know that water is essential to life. It's just never gonna go away or stop being important or relevant, and it's a multi-billion-dollar industry, so investing in that market long-term makes perfect sense to me. And in the case of Xylem specifically, well, they handle everything from water treatment to water storage and transportation. They work in hydroenergy, utilities, industrial use. They're especially big in water-related machinery and equipment like pumps and filters and meters and a lot more. And they even have all kinds of smart services and software for the management of water as well, all of which is crucial to virtually any water-related market you can think of, and that's why they've been able to grow into one of the biggest leaders in the space, doing over $5 billion in sales just last year alone. And yet they still estimate that their serviceable market is worth much more at $60 billion, which is also within the even bigger addressable market of $600 billion for the global water industry, which is also why their sales continue to grow by so much. And while this year's 30% revenue growth is in large part due to an acquisition, next year will still be around 15% growth anyway, and that's very impressive. The company is also solidly profitable, which they used to also pay a dividend that they've actually grown every single year since going public in 2011. The yield is pretty small though, at just 1.5%, but it's at least got some excellent growth metrics on it, so long term, it's a nice little bonus to have on it. And most recently, the stock has gone through a noticeable dip, falling almost 20% this year and down 35% from its all-time high. So this could be a great entry point into the stock if you're looking for one, as it now leaves their adjusted PE ratio over 20% cheaper than their own 5-year average. It's typically an expensive trading stock. Right now it's a bit lower than that. However, even here it is still overall pretty expensive. I mean, when you compare it to the sector, you're talking around 50% higher than the sector median. So I think I'll probably wait a little longer myself before buying in, given that the economy is pretty weak right now. I think a broader market correction, would definitely drag this one down a bit lower at this valuation. But overall, I still think that this is a very solid stock to invest in long term. So I agree with Vanguard's move here to pick it up on the dip. And I'll rank it pretty high myself at number 2 until I see what else is on this list. It's definitely a stock that I could see myself owning in the future. Moving on to stock number 2, though, we actually have another stock here that I don't think I've ever covered before on the channel, and that is CoStar Group, ticker symbol CSGP, which Vanguard has been buying more and more of each quarter, and they now decided to increase their position again by a whopping 44% with about 20 million more shares, bringing the total stake in the company up to nearly $6 billion. Now, this is mostly a real estate technologies company that provides real estate data and analytics, while also being the parent company to some of the most popular, I should say, and largest online real estate marketplaces like apartments.com, homes.com, land.com, 10x, LoopNet, and many other websites. Basically, when you're out there, searching for real estate on websites, chances are pretty high that you might be using one of their services, one of their websites. Now, the company's revenue is mostly fee-based, meaning that it earns money from online bookings on those various marketplaces that we talked about, while also collecting subscription revenue for its data and analytics services too. And a lot of big companies hire them for that data, those analytics and stuff like that too. And that's really been a winning combination for CoStar. Since really the broader real estate market has been on fire over the past decade, really ever since the housing market crash of '08, it's just been on fire ever since. It's been soaring, and that's given them huge revenue growth over the years. However, you'll notice that we are going through a noticeable dip here in the housing market these past few months, which has everything to do with our really high interest rates that have also sent mortgage rates up to nearly 8%, which is the highest it's been in decades. So there's definitely a lot of macro weakness out there, and especially if we go into a recession, I would also expect that the housing market continues to fall right along with the economy. And yet, because of recent acquisitions and expansion plans, CoStar is actually still expected to see double-digit revenue growth in the coming years, which is pretty impressive. It tells me that their services are probably in very high demand, and they're really good at what they do and what they offer. And for me personally, I do love their business and I would be more than happy to invest in the stock. However, this is a very similar situation to Xylem, where the stock valuation is just a little too high, and that's even more pronounced here, as the stock has more than doubled in the past 5 years and is essentially trading near an all-time high, with a valuation that is significantly more expensive than the sector at a PE ratio that is, like 140 to 170% higher, and a PS ratio that is 244% higher as well. That's just too rich for my blood, and I'll have to rank them lower because of it at number 3, even though, like I said, I do like the business. I think both water and real estate will always be critical markets of the future, but Xylem gets the edge here for having a better valuation. Okay, moving on to stock number 3, though, we have another industry that I think is super important for the future. So we had water, we had real estate, and now we have cybersecurity with one of the biggest leaders in the space in Palo Alto Networks, ticker symbol PANW, which Vanguard increased their position on by over 30% last quarter, bringing the total stake up to $6.7 billion. And yeah, what's not to like about Palo Alto? I mean, they're currently the world leader in cybersecurity market share, doing more than double the sales of most of their peers. They have amazing technologies, implementing AI and machine learning into their various platforms to automate the detection of online threats much faster and more efficiently than a human counterpart ever could, which, by the way, is a very attractive proposition to big companies and institutions that are obviously going to be trying to run more efficiently. And because of their unique multi-platform strategy consisting of Prisma, Cortex, Strata, and Unit, they've also been able to offer more choice and more customization to each specific customer and their specific needs. But once again, we have another case here of just too rich of a valuation after seeing the stock soar to an all-time high in recent years, leaving it more than double the valuation of the sector median on adjusted earnings. I mean, if I really wanted to own the stock, I could argue that it's at least cheaper than their own 5-year average, and the PEG ratio of less than 2 is also pretty close to the sector as well, which does indicate high earnings growth in the future. But I feel like I'm just kind of making excuses here. Overall, it's still too rich of a stock for me to be buying in such a weak economy that we're currently in. So I think I'll wait around a bit to see if it ever gets dragged down to a more attractive price. But for ranking purposes, well, I would say that I think Xylem is the kind of better overall stock, better valuation in my opinion than the three. I do like cybersecurity a little more than real estate though, so I'll put Palo Alto somewhere in the middle here at number 3, and I'll bump CoStar down one spot to fit it in. But that will, however, leave us now with the final 2 stocks of the list, and you're going to want to stick around for these ones because they are 2 of the largest stocks and companies really in the entire world, which could potentially throw a monkey wrench into our entire ranking so far. But starting with stock number 4, that's going to be the retail behemoth known as Walmart, ticker symbol WMT, which Vanguard only increased their position by less than 5%. However, it's a much larger position than the others at well over $20 billion. And I mean, a large position in Walmart does make sense here for such a, huge investment company like Vanguard, since Walmart is reliable, having been around for so long and completely dominating the retail space by expanding huge warehouse-like stores that sell just about anything you might need at much lower prices than most other brick and mortar retailers, which has led to the most retail market share in the entire world for them and just mind-blowing financials of over $600 billion in sales over the past year alone, which has also allowed them to reach dividend king status, having now increased their dividend for over 5 decades in a row. However, there's a couple reasons why I've never been the biggest fan of Walmart stock, and for one, I would say that the dividend is really tiny at less than 1.5% yield, so I don't really factor that into my decision. But more importantly, ever since Amazon stepped onto the scene, I just felt like owning them gave me all the exposure that I really needed in retail. Online shopping is obviously the future. Amazon is the king of that. And when comparing the 2 stocks, I mean, Walmart continues to trade near an all-time high, while Amazon has gone through a recent dip, leaving it trading considerably cheaper on a more forward-looking PEG ratio, which is also due to Amazon just being better diversified and having more future potential in not just retail, but also cloud computing, advertising, artificial intelligence, entertainment, and a lot more. And that's why their sales are still growing at a double-digit rate, which is more than double that of Walmart's. Now, I know Amazon isn't on our list here, but I just think that because there is such a clear, better choice out there, it kind of makes me have no interest in owning Walmart. And I do think that it should be factored into the ranking. And because of that, I'm actually putting them in last place. I know that might shock some of you. Walmart is a pretty popular stock to own, but I would just rather own Amazon and any of these other stocks on the list as opposed to owning Walmart. So it's going to go in last place. Okay, speaking of stocks that I like to own though, stock number 5, the final and largest holding that Vanguard is buying, is actually going to be my own number 1 largest holding in the almighty Microsoft, ticker symbol MSFT, which they just barely increased their position on, but it still makes up over $220 billion at over a 5% stake in the company within their own holdings, which none of these other stocks even come close to. And I gotta say, I fully agree with that position, and there's several reasons why. Microsoft completely dominates the PC and business markets with their Windows operating system, their Office productivity suite of applications, LinkedIn, GitHub. They have the second largest cloud platform only behind Amazon. They make their own computers with the popular Surface line. They do just about as much work in artificial intelligence as anyone else out there. And by the way, they're the primary backer of ChatGPT, which is being integrated into many of their own services too. And I even think that they'll become the largest gaming company in the world too, where they're already the 4th largest by sales, and as soon as their massive acquisition of Activision Blizzard closes, which is the 7th largest, well, they're only going to become even larger over time. Plus, all of their recent acquisitions, huge ones, will help fuel their Netflix-like subscription service called Xbox Game Pass, which I think has gigantic long-term potential. But all of that has led to amazing financials and some of the best, most robust profitability in the entire market, doing almost 200 billion in sales and 80 billion of pure net income profit just last year alone. And yet they're still somehow growing at a double-digit rate for both sales and EPS. How crazy is that? I absolutely love Microsoft stock. Unfortunately, it rarely ever dips, but I think that's always going to be the case with this one. The valuation will probably always be very rich, but you really get what you pay for with Microsoft, and I personally feel that they deserve the premium price tag and the #1 ranking. It's definitely the type of stock that you want to go ham on during any kind of market correction or crash, because that's really the only thing that can kind of drag the stock down, in my opinion. But anyway, that'll leave us now with our final rankings. I put Microsoft at #1 for the best overall all-around quality, Xylem at #2, which I think is a sleeper stock that I'm actually getting very tempted to start buying myself. Then I put Palo Alto at #3, followed by CoStar at #4, which I love both of their businesses, but would only want to buy at a cheaper price tag. And then I put Walmart at #5, who again is a solid stock, but I just think Amazon is clearly better, so I have no real reason to own it. And so in conclusion, I would say that I actually do really like these pickups here by Vanguard. They are obviously on the more expensive side of things. That would be my biggest criticism. I think they could have balanced it out with some value, especially if it was us smaller investors. I think we'd definitely be looking for some cheaper stocks to invest in. But, you know, when you're at the size of Vanguard and you're looking for that stability and price doesn't really matter too much to you and you're just buying the highest quality of everything, yeah, I mean, it makes sense. These are all great businesses that will probably thrive long term. So pretty good pickups here. And I would love to hear your opinion on them, though. What do you think? Do you own any of these? And do you agree with my ranking of them? Or would you make any changes? I'd love to hear your thoughts down in the comment section. I'll try to respond to as many comments as I can. But thank you again so much for all your support. Thank you for stopping by. And I will catch you in the next video, my friends. Hope you're all doing well. Take care. Bye-bye.